Welcome to the fourth and final edition of the Virtus Wealth Management COVID-19 webinar series. I'm Josh Hubman. Thank you for joining us today. We're lucky to be joined by both partners of Virtus Wealth Management today. We have life insurance counselor and certified financial planner, Chuck Elhoff. And we also have the certified private wealth advisor in the office, Brian Tillotson. So thank you for joining us today, guys. We appreciate it.
Thank you.
All right, be nice to us.
I will.
Right.
Well, you're going to have to ask everybody else to be nice because this is their questions today. What we're doing today is we're looking at where do we go from here. We've had 3 webinar parts already talking about different things that have happened, but today we're really looking forward and we want to get, your guys' opinions and everything on what we should see going forward here. So we've had people submit questions. Thank you for doing that if you already have. And if you haven't submitted one yet, you'll also be able to ask that live at the end. So stick around and you'll be able to speak your question to Chuck or Brian here. And so if you don't want to speak, you can still also email those in. You can email that to Amy Tillotson. That's who you got that webinar invite from. So any way you want to ask one, we're here to answer those for you.
Really going to let them do that?
We are. You'll be able to speak your own question at the end. And we're also...
But here comes the disclosure.
Well, before that, we're trying to make this as interactive as possible. So throughout, we're also going to ask you to raise your hand. And so you'll see that in the bottom center of your screen. If you move the mouse over that, you'll see that you can raise your hand. And so we'll be asking kind of some poll questions to get how you guys feel about a couple different things. So I want to ask everybody to do that right now. Click that button, raise your hand just as a practice round. No need to lower it. We'll take care of that, but just raise those hands. All right, looks like everybody's got them. So before we get into the questions, just need to say a couple things that, the opinions that we voiced today, are material for general information only, and it's not intended to provide specific advice or recommendations. Investing involves risk, including loss of principal. No strategy guarantees success, and not all items discussed will be suitable for everyone. And so, with that said, the way I want to start this, Brian, is pretty general question, but, we've seen the market pull down in mid-March, down 20 or 30%. But since then, we've seen a pretty sharp recovery here. So, with that recovery, has this kind of changed your opinion about the market and where we sit today going forward?
Yeah, I think that's a great question because what we have to be careful with is stubbornness. Stubbornness can get you really in trouble in investing and cause you to lose a lot of money. So when we go back and we look at it and we say, okay, we always need to be updating what we're thinking based on the information that we're seeing. And so before, I never bought this V-shaped recovery of the economy, right? And just so you know, V-shape is just looking at, GDP drops like this, and then it comes straight back up. That's a V, right? They're just basing it on the letter. And then there's W's, and I always thought it was going to be more of a U, right? So U, we drop, and we go down here for a while, and then we come back up. So I guess they've run out of letters, and we've now gone to swoosh. So think of the Nike symbol, if you will. And so, right, so you're going to go down and then you're going to come back up and then it's going to kind of level off and grow. We've got a chart to show you later on that, right? I'm starting to think that's going to be it more than my original view of a U-shaped. But I still do not believe we're going to see a V-shaped recovery. I'm not sure if you saw or if people have heard, but the Fed chair just spoke last night and he warned people that this is going to be a long recovery. We need to understand it's going to be a long recovery and not buy into some of this hype and hysteria that's going on in the markets and everything else, because it can cost you on that. And so, bottom line, that's kind of where we're at. And we're going to get into more detail on that here in a second. Before we do, I do have 2 questions. I've done a lot of presentations. Many of you have seen me do those. And one of the things you want to do in a presentation is get people involved, right? You want people to be engaged. And it's very hard on a webinar because it looks like we're just talking to each other, but we really want to talk to you. So I have 2 questions. Again, we're going to use the raise the hand thing to answer these. But the first one, and this is kind of an important one when you think about it, right? Because there's a lot of fear and out there in the media and everything. And so the question I have for you right now, do you feel comfortable spending money as you did before the virus? So let's say you're thinking about buying a car, or you're thinking about buying furniture or going on a trip, and let's forget the the travel issues with the virus. I'm just talking about spending money. Raise your hand if you're just as comfortable today spending money as you were before.
All right, we'll give you a couple seconds on that one here.
All right, so you checking that? Okay. Yeah, well, let's, 1 second, we're going to see that.
Yeah, about half.
Okay, and see that's very interesting right there, because we have about half of you that would spend today. That's not good news when you look at consumer spending, but what we've seen in the reports are people are spending money, and that we're not seeing a huge drop in spending. Now, how much of that's because of the $600 bonus for unemployment and some of the other stimulus plans, we don't know. That's going to have to be determined. But you know, for right now, we've changed our mind. I'm going to get to the other question later because I'm running out of time and I'm getting this and I'm starting to get the music playing. So I'm going to turn it back over to you, Josh.
Yeah, absolutely. Great answer on that, Brian. Thank you for that. And so, Chuck, I'm going to move to you here. One of the things that I really like talking to you about is, you know, your past experience. You've, you know, been working with your clients for a long time and been through various market downturns and different environments. So just wanted to kind of get your perspective on this market downturn, how things could be different in terms of a recovery here.
Yep. Well, you're right. Since 1970, we've had 5 recession bear markets. And yes, I've been through all of them. It's my 6th. And we've also had 7 viral attacks. Nothing came of having a recession or bear market out of those, however. So, yeah, so I think all of us have been through the most recent one, the 2008. Mm-hmm. Now, that was 18 months to hit bottom. And so in that process, it took the government, Congress, like 12 months before they ever came up with any kind of relief. And it was another 18 months before they came up with a private personal investment program that was going to help relieve things. So what's different? Well, in 2020, we hit bottom in a month. So it was much quicker than what it's been in the past. And it's also the first one that was caused by a disease, because like I said, there was 7 viral attacks in that period in there. But this one was caused by a disease. The other one is that we're sitting here at 0% interest rates. So there's not much you're going to do to adjust for interest rates. Yeah. So, you know, we have those type of issues. And then the other funny thing is in January, February, I mean, our economy was strong, right? Yeah, okay. I mean, we were cooking. We were loaded. So what happened is we have this pandemic and the United States shut down. But not only the United States, the world shut down.
Yeah, exactly.
And so everything was locked down. It's like, ah! So what happened is the central bank made exercise some options. So they started right away doing things. And within a month, Congress had passed some stimulus package. Now they've done 3 stimulus packages. So we're being entirely different than what we were before. Now, the other funny thing is within a 3 to 4 month period, we were down 20% bear market. April, we're up 20%. Now we're in a bull market. It's like, really? So this thing is entirely different than what we've ever experienced before. Yes, so I would use a weather analogy here to kind of compare how this one looks compared to the other ones. Okay. So, you know, if you have a drought, and of course we're in Texas and we experience droughts, well, you can go 1-2 years with the drought, but as soon as it rains, everything's back the way it was before. Well, in this case, if you have a tornado, buildings are leveled, ruined, hurt. It ain't going to be the same. Now, what's going to happen is you have to assess the damage, figure out what's going to be rebuilt, what can be repaired. And so I think that's fair to look at what we just experienced from a recession, from a bear market, is a tornado. Yeah. And we're really still assessing the damage. Now, the other thing that's going to happen is when we come out of this, not like a drought, it's not going to look the same. You know, you're going to have new buildings in a tornado. Some are going to repair to have different. We're going to come back. It's going to be there. But sitting here right now, we're just in assessing damage stage. So yeah, that's kind of my perspective on what I see different than what I've experienced in the other 5 that we've been through.
And one thing you said there kind of leads into another question that a lot of our clients have been asking. And, you know, that's with insurance companies and their insurance policies. You know, interest rates are near lows or, you know, almost 0 right now. So what kind of impact is that going to have? You know, insurance companies or policies that people
think insurance companies are going broke? You know, my dad was a farmer after, I remember this, he always talked about it, complaining about it. He says, you know, son, the insurance companies have all the money. says, yeah, you're right, Dad, but that's like saying farmers have all the corn. They better have all the money. I mean, that's what they're there for. I don't see insurance companies going broke. Their portfolios are pretty much made up of AA bond portfolios, mortgages, and you're right, interest rates are low right now.
Mhm.
So the biggest concern that I would have in looking at policies now, and for clients out there, is, you know, I would ask how many have universal life policies, how many have variable life policies, ask you to raise your hand, and quite frankly, I'm quite sure you say, I got them, I don't know if I have them or I don't.
All right, here we go. Raise your hand. Those of you with life insurance policies, universal life, whole life, anything cash value life insurance policies. This question.
Oh, look at that, adding up quick.
All right.
Excellent.
We're more than half there. Very nice.
So my concern is going to be with the universal life policies and the variable life policies. As you mentioned, interest rates are low, and they've been low since like the mid-90s.
Mm-hmm.
And so many universal life policies, when they're purchased, you assume a rate of interest that you're going to earn on the portfolio. And that's what's determined the level of premium that you pay.
Yeah.
So what happens is you're paying these premiums, your insurance cost goes up every year, and you're counting on the return on the cash values to kind of offset that and stay ahead of the game. Well, I can assure you that most all universal life policies now are at the guaranteed interest rate. And we're talking 3-4%. Illustrations were probably done at 6-7%. And so as you get older, that cost of insurance goes up. And if you're not getting the performance on the cash value, you're looking at a situation where the policies could lapse. And so we want clients to do, and this is easily solved if you just run an in-force illustration and say, okay, how much additional premium should I pay to make sure this doesn't lapse? Because if you let it lapse, the insurance company's going to hug your neck all the way to the bank, because I mean, they've got the money and they don't have to pay anything out on it. Variable life, it's a portfolio of stocks chosen by you, the insured, chosen by you and your agent. Similarly, we got market downturns, and so if there's anything I would ask everyone to do is this year is one year where you want to look at your policy statements and just see where they stand. And as a service that all of us offer, we're happy to look at them, go over it with you, and help you resolve that, make sure that you're not in a lapse situation.
Yeah, I was going to say, for everybody who say, what do you mean variable life, universal life? What does any of this mean? You know, you can give us a call and talk to us about your specific situation to get a little more information.
And the whole life policies are guaranteed cash value, so those are contractually guaranteed. In an environment like this, clients are very comfortable because they know those are safe. But many policies are what they call participating and have dividends. So yes, we have a similar situation there. Dividends are less. Back in the mid-90s, 8% dividends. Back in the 2000s, it was 6% dividends. Now we're in the 4% dividends. Interest rates coming down. But still, you're getting 4% tax-free, which that's kind of nice. And that kind of leads into what about municipal bonds, stocks, all other stuff that we could be looking at. But those are my main concerns just on the universal and variable life.
Good. Thank you for that. And so, Brian, you know, where we sit today, I want to kind of jump back into the market with what we're hearing from people is, you know, and a lot of people ask this, okay, Brian, what worries you about the market? You're looking at this stuff every day. I don't usually look at it every day. What worries you about this market?
Okay, so that's a tough question to answer without getting into a little bit more detail than I need to, but I have to only to answer the question with the right way. So when we're talking about this, there's a couple of things. First, you know, kind of ignore the news right now. I think the tornado analogy was perfect because I'll give you an example, unemployment. And I'm going to ask a question, get everybody involved, raise your hand again. So how many people here know of someone who is not going back to work because their unemployment benefits pay more than they were making before they were let go, right? I mean, I expect to see a lot of hands, right? Do you know of anybody who is deciding not to go back to work because they're making more money on unemployment, right? Now that goes on until July and then it stops. We also haven't really got all the way through the PPL program and when you have to keep people on board. So any unemployment number today.
Yeah, a couple people can relate there.
Yeah, we can see that. Yeah, thank you. So we're in a period right now where the information coming out really is almost meaningless. We need to find out where unemployment stabilizes 3, 4, 6 months ago, 6 months from now. So I think the uncertainty of where everything is headed, because this is not something we've ever seen before, you know, this pandemic and shutting down the economy is one thing. The other one, and you know, this is where I get into some detail, but it's what's called credit spreads. Okay, so the smartest in traders out there are not stock traders. It really isn't. If you look at it, we all refer to the bond traders. If you want to see where the stock market's going, look at the bond, right? Bond market. For example, if you've heard about the inverted yield curve, and that's when the long-term yield gets lower than the short-term yield, right? And that is supposed to indicate that a recession is coming. And it's not perfect, but it does have some success to it, right? So that's the bond market telling you 9 months from now, we're going to have problems in the economy. We're seeing,
not there yet, though, on inverted.
No, we're not in inverted. Thank you for clearing that up. But we do have a really big disconnect between the bond market and the stock market, and it worries me. And here's what it is, all right? The bond market, you look at credit spreads, and the credit spread is basically, here's the treasury rate, which we consider the risk-free rate, right? It's at, let's say 1%. It's not, but let's just say it's 1%. And then you have corporate bonds at the same term that are at 3%. That means it has a spread, a credit spread of 2%, which means you're taking on risk, so you should get paid more. That's how they determine the risk. So if that credit spread grows and you're making more on a corporate bond than you are the treasuries, what that's telling you is the bond market's saying you're taking on more risk to get that return, right? So you're taking on more risk. So the higher that gets, that means the bond market is telling you there's risk in the economy and there's problems. So right now, well, about a week ago, the credit spreads were worse than we've seen in 20 years, with the exception of 2008. And keep in mind, 2008 was a complete credit crisis, right? So that was even something different we haven't seen in 100 years.
So that spread right now is really wide.
Really wide.
On the bond
right.
market. Yeah.
So if I told you the credit spreads are really wide and the bond market is expecting bad things in the economy, many people would go, okay, that probably means the stock market's PEs are low, price of earnings, just the way we value it. Not to get into too much detail there. What we're seeing is very high valuations and very high credit spreads. Something's got to give there. You can't have the bond market saying, hey, we've got troubles, and the stock market saying, oh, everything's great out there, right? And so that really worries me on that. And if you can, and then I'm going to pull up one other thing, if you can do the GDP one. We're going to share a chart with you. All right, so the first step.
Yeah, let me set this up real quick so everybody knows
Yeah.
kind of what they're looking at here. Hopefully everybody sees this all right. So we're looking at consensus estimates for U.S. real GDP growth. And that's GDP is gross domestic product, basically what a country's output is.
Yeah, it's made up of 4 things.
Yeah.
So it's a consumer spending, it's what government spend, it's what export imports amount to. And so there's been a lot of government input that they were talking about, millions and trillions there. So, but the consumer spending, all that stuff.
Yes.
GDP. It's all
So this is the amount of GDP on the side in trillions. And the dotted line is what were expectations before COVID hit. So that's the dotted line here. And then you see the blue line, Brian will describe branching off here. This is when COVID hit. So these are estimates pre-virus and then post-virus. And kind of you can explain what you're seeing here, Brian.
All right, so not counting today, because if you've noticed, the market's getting killed today for 2 reasons. One, the fear of the wave 2 of the virus, as well as the words by the Fed that I just mentioned earlier. So not counting today, but if you look at it, we were almost back to even. And in some areas in the market, we were back to where we were in February. Okay, now to me, that's just not logical when you look at this, right? There's again another disconnect because, and if you look at that blue line, remember when I was talking about the V versus I guess that's kind of the swoosh you're looking at, right? It comes down and it's not straight back up. It's got a little swoosh to it, and then it kind of evens out. If you take the 10 banks, and that's what this is, the 10 banks, largest banks, the estimates are basically third quarter of 2021 before we get back to the same GDP as we had before the virus. The Congressional Budget Office says it'll be the first quarter of 2022, right? So you're talking about a situation where we don't even get back to where we were for another year to year and a half, but the stock market's back where it is today. That again, that's another disconnect that it just doesn't run. So I'm not worried about some great recession or something like that. I just think the market's way ahead of itself. I think the recovery is going to be probably better than what I first thought based on some of the numbers we're seeing on out there on spending and everything. But there is a disconnect, and we've got to understand the bond market is telling us one thing and the stock market's telling us another.
Okay, that leads into the next question here. So people experienced a big drop, a lot of people in March. and seen it come back. So now they're wondering, okay, if things are still worrisome, do I go to cash here? If they have cash, can they invest it now? You know, kind of what are you seeing, you know, in regards to that?
Okay, so I hopefully have made it clear through my time here that I believe going to all cash is a bad strategy that does not work over time. Number one, by the time you feel comfortable getting back into the market, it's too late, right? So you're waiting for, if somebody goes to all cash, they're waiting for things to be really good. Well, the market looks out 9 to 9 months or so. So it could be horrible today, but if they think the market's going to be good 9 months from now, it starts moving up before then. So if you're waiting around for unemployment to be back to where it was and all that kind of thing, then it's just not going to work. So I'm not a big fan of that. I am a big fan of risk on and risk off. And a lot of this depends on your risk tolerance, your age, you know, what you need the money for. You know, for most retirees, you know, preserving capital should be the key. So we're talking about an environment here where we have no idea what's really going to happen, how big the wave 2 is going to be, if it is going to be one, you know, so what's going to happen with unemployment that we talked about once all this stuff settles down. So there's so many unknowns. So taking a lot of risks doesn't seem prudent to me. Now, if you're young, I don't see why you would be all cash, right? Just make sure you're investing in the right areas is the key. So to answer that question, please don't go to all cash from a long-term perspective. And again, this isn't specific advice to any one person out there. I'm just talking general. And then 2, whether or not you should get into the market right now depends on your risk tolerance. We've nibbled some over the last month, bought a couple of companies that's worked out for us and everything, but we're still risk off out there, and we're still going to be, because as I've explained, I don't believe in the V-shaped recovery of the economy or the market. I think the market got way ahead of itself because Chuck brought it up. It's a great point. In 1 month, we dropped 35%. You know, we keep setting all these records. In 2018, we set the record for the worst month, you know, ever. And it's because of the way or the time information is passed now, right? With internet, everything, we know everything today, whereas 10, 20, 30 years ago, you'd get the news the next day. So just be careful out there and understand it's all about your risk tolerance.
Yeah, that's the financial answer. You know, at the same time, it's your money. And if a client says, I want to go all cash, that's the only way I can sleep, I mean, they need to go to all cash. But from a financial standpoint, as Brian says, it doesn't make sense. I mean, it's like having a car and having 4 spare tires. I mean, I guess that makes you feel good, but it's kind of wasteful. So it just doesn't make a lot of sense. But certainly we do listen to our clients.
If you told me you wanted to go all cash, I'm going to go all cash.
They sleep at night. They will help. That's what we do.
Plus, that's the quickest way for me to get a lawsuit. Nah, you don't need to go all cash, and then that happens, right? So, yeah, most definitely.
Yeah, keep that perspective.
Well, you're talking about all the different records we're setting in this environment, right, with the market. Another one is the amount of stimulus that we're putting into the economy right now, right?
Right.
And I think that could be seen as a big reason for the sharp recovery here. So with all that stimulus, you know, where's that money come from? How's that going to affect us going forward?
Where does that money come from?
Since we're talking about down the road, and I'll open this up.
Paying those taxes now, you know?
Yeah,
I think that's a concern that we've had. We've discussed that you've got, again, billions or trillions of dollars out there that's got to be paid back somehow. And it's certainly, I think, the situation from a tax standpoint going forward is something we've got to be cognizant of. So whether that's municipal bonds or the different portfolios that you put together that are going to be favorable to that, we got to talk about that.
Yeah.
It's got to be a topic of discussion.
I've been a pretty big proponent for years that the deficit is not the issue that people think it is. One, we have to make sure we look at the deficit as per GDP, not just gross numbers. So somebody will say it's 20 trillion today, and
it's relational.
Yeah, it's relationship, right? So, you know, it's just like your house, right? If you make, you know, $100,000 a year and you've got a $50,000 loan or debt, that's different than if you make $40,000 a year and you have a $50,000 debt, right? So there is a relationship between those, but we are crossing a point where we go, okay, you know, there is an issue here that we're going to have to address with taxes. But let me back up here a little bit before people blame government or whoever, and some people do. We were going to have this issue either way, right? I mean, yeah, you know, deficit becomes from your revenues that come in versus your expenses, right? So if we didn't do anything, the government didn't do anything, no stimulus package, revenues drop way down here, right? We don't have the tax revenues. Well, most of our cost, as people know, are fixed costs. We're not going to be able to bring our government spending down by 30% in 1 year. So you have this, and let's say that happens, and then the recession gets really bad, and it lasts for 2 years or so. Well, now you've got this. You're still going to have a huge increase in your deficit. It's just going to happen, and maybe we added more than we should. That's for the economists to work out. So understand that we're going to have the issue anyway. It's not as dire as people think because we can grow ourselves out of it. We have in the past.
Yep.
You know, World War II, we came out with a huge deficit issue, and we grew out of it. But when you look at taxes, considering that we're pretty much close to historical lows on our tax rates, I think it's wise to think, okay, they're going to go up, and to plan accordingly, like Roth conversions, which we're big fans of, and other strategies like life insurance for those that need that. So yeah, I think that cash value life insurance. So
yeah, that's great. Well, it's enough hearing from me. Time to hear from all of you. So we had some pre-submitted questions, which I'll get to first here. Thank you everybody for sending those in. And if you have a question that you want to speak, get that ready. After these, we have a couple.
Let me just say, so we're going to do this where you just raise your hand, right? Just like he was talking about before, and then Amy will chime in and let us know who has the question. And we will not call out your full name or let anybody know, or you won't show up on the video, right? So you don't have to worry about showing up on video or anything like that.
Yeah, if you want to ask a question, you'll raise your hand. Amy will unmute you. I'll let you know, and then you can ask it.
Yeah, so if you're in your pajamas, you don't have to worry about everybody.
So get ready for that. And you can always email them in still if you have any. So we'll get to some that were sent in previously. Scott B asked, so what impact do the protests have on the market and your potential outlook of the market going forward? And that one was posed to you, Brian.
Oh, for me? Okay, so, I mean, that one's, I'm not going to get political here at all because that's not what this is for. But I will say, keep in mind what I said earlier, right? The market is looking out 9 months from now, a year from now. So, what's going on today really doesn't drive that. So if you believe that the protest and riots are going to continue on for a year, then you want to be a lot more cautious. But look at the market. The market's not pricing in that to happen. So the market, these protests and riots have been going on. The market's still going up. So the market is telling you they don't expect that to be an issue longer term. But I will add one thing that I found interesting. There was a good article in Wall Street Journal the other day about if you keep throwing things on people, sooner or later they get to a tipping point, right? So we have the pandemic, and there's the scare from that, and I know there's a lot of people that believe that we shouldn't have been, but there was, right? Then you have the lockdown, which really frustrated people and put people in a real bind, and then you just have the depression and everything else of staying home all the time. Then we have the protest. So, how close are we get to a point where we have a tipping point?
Enough's enough.
Enough. And what I mean by a tipping point is people get real negative overall, and then they stop spending money, they stop doing things, and then that hurts the economy. So, we can say the protests by itself don't hurt the market for what the market is telling us, but we got to be really, really careful and realize that there's some things that are adding up, and the frustration level could come to a boil at some point and really impact.
I think you're seeing some of that as a result. That's exactly right.
All right, I got another question. I think this one would be great for you here, Chuck. This was from Mike M. Thank you, Mike, for sending this in. What is the outlook on industries like entertainment, tourism, hospitality? How long do you think these things will take to recover? So I know you are a big sports fan.
How long is it going to take to get going?
Yeah, how long do you think until these things? I know it's tough, but what kind of advice can you give those, working in those industries or who like to enjoy those industries?
Well, I'll get a couple thoughts here. One is back in 9/11, every airplane in the country was on the ground for several days. So you got to think, we ain't ever going to fly again. I mean, that's just the natural inclination. So we're sitting here with movie theaters closed and limited amount of flying. Cruises are being canceled, trips are being canceled. So it's just natural to think that, this is not ever, yes, it's going to come back. I don't see people, just like Brian was alluding to earlier. I know my dad feels like he's in prison. He says, it's my brother, take him out for a ride. So you can't be cooped up forever. Life is going to go on, but it's going to change. And so again, back to my analogy on the tornado, when you have houses and buildings destroyed, somehow or another, people are going to adapt to get it back to where it was. So just like flying, we went back to flying, but now what we do, we go through TSA. Everything's different. Everything's a little. So these companies, I feel, are going to all adapt in some way or another so that people can still participate, so people can still be entertained. You know, I'm a big baseball fan, big sports fan, basketball, football, golf. I expect we'll be sitting in the stands, but it's probably going to be different. I'll be zapped, I guess, where you walk. I don't know. But I was joking earlier. I says, you know, they said in baseball, they'll play baseball, but there's no spitting or high five. I go, really? How are you going to do this? So it'll come back. And I think it's kind of like what Brian was referring to on the GDP projections. I mean, it's going to take, you know, a year.
Okay.
It's just going to take some time, but it'll evolve. You know, we're going to adapt. You know, that's who we are.
And then the question becomes, you know, how big does the second wave of the COVID-19 become? I mean, that gets back to your point, don't you think, about this? We're in the tornado. You know, any other period, you know, if we talked about an inflation-driven recession or a inventory-driven, you and I could sit there and say, okay, here's some history that this has taken this long. Man, I could really tell you some answers. But then we're talking about something we've never really seen before. And it's like, okay, we're already talking about a second wave that I think is being a little bit exaggerated out there, but we're talking about the second wave. But what if it does really hit? And you know, we see that, and you know, that's going to change everything. Or there's a you know, medicine that comes out and a vaccine that comes sooner than expected. Nobody expects it in the next month. You know, that's going to open everything up. So there's a lot of just unknowns with where we are to make it really hard. I mean, it's not it would not be a sector that I would be jumping in at.
Oh, no,
at this point in time. But
I agree. But I think you have to be cautious. All of us need to be cautious when we're listening. I had a friend years ago who made some statements and wrote a book, and I says, you don't know that? He says, I know I don't know that, but if I'm right, I'll be famous. Yeah. And if I'm wrong, everybody will forget about it. Well, you've got these scientists and different people, just like the second wave, they're predicting summer's going, and then they're going to be a fall one. And then it's, you know, if they're right, they're going to be famous, and and if they're wrong, everybody forgets about it. So
it's like the guy that predicted the 2008 bear market and recession. Yeah. He also predicted 12 other ones in the 15 years before 2008. But he got that one right.
Until I get it right,
yeah,
I post it out there, and all of a sudden I'm famous. That's right. So.
All right, thank you for that, Chuck. We are now going to see, so anybody wants to speak a question, go ahead and get your hand up, and Amy will unmute you, and you'll be able to speak that question. So.
Okay, while we're getting there, let me just add, I forgot one stat that I wanted to say earlier about the market being ahead of itself.
Yeah, go ahead.
Right, so the top 10 banks average S&P projection for the end of the year is 2950. So take a look at where the S&P is today and look at what their average. Now that they can be wrong and everything, but that kind of tells you again where I'm talking about. I think the market's ahead of itself. But okay, I think we got a question.
Yeah, it looks like we got one. All right, so it looks like we have Martha W. If we want to go. All right, Martha, can you hear us? Looks like you're unmuted. Go ahead and ask your question.
Yeah, hey guys.
We can hear you.
Okay, it seems like more and more companies are deciding to have their employees work from home. Ongoing factor, even post-virus. What do you think the long-term impact of this will be on certain sectors of the economy that are mostly impacted by this?
Yeah, see, I think that's a great question. And, you know, if you don't mind, I'll take this one.
Yeah, go ahead.
You know, so we've reduced our weight in real estate and some other areas for the very reason you're talking about. You know, for years, we've heard about this move to online shopping and that the end of the brick and mortar retail. And the problem with that is people still want to get out, right? I mean, we've just talked about it. Nobody wants to be stuck in their house all the time. And we are seeing increases in online, no doubt about it. But, you know, the death of retail was the brick and mortar retail. I always thought was a bit of an exaggeration. What we are seeing, though, is a move more and more. Now people are more and more comfortable shopping online. So it's about getting that comfort level of, hey, I can just click a button and I get it the next day or same day in some cases. So, you know, real estate, I think, is, you got to be, now there's good parts of real estate and there's bad parts of real estate, right? I mean, it's huge. And that goes for everything. So there are going to be some areas that are hit. And one of the areas I'm worried about gets back to a point we talked about earlier is travel, right? So travel's, I think, has a couple of obstacles that's going to keep it hurting for a while, and that is, one, people getting comfortable traveling overseas, right? And then the second part of that is business travel. I'm a big football fan, so I'm going to put this on the football side. What we're seeing in recruiting at the college level is people are saying, we don't need to take all these trips for recruiting. We can Zoom meetings with the kids first and second, make sure, and then get to know them that way, and then just take more of that. And so we're going to see businesses across the globe go, hey, we might not need to travel as much as we do. And then keep in mind, you know, Martha, because that's a great question, then you've got that second layer, right? So travel is hit. That means less demand for oil. You know, I think we've got a real issue in energy that's going to last for a while. This is not going to be a short-term problem. So now we're going to, you know, we have less demand. So that has an impact there. So I think this leads to the real important part is this is going to be a stock picker's market. This is going to need active management. You've got to avoid certain industries like maybe real estate and energy and air travel. And then you've got to be smart about which industries you're going to go in. So if I can add to that, so Martha's question about people working from home, I think this will be an opportunity to see a couple things. One is, can they actually accomplish this and still be efficient? Now, if they can, then understand that there's going to be some significant savings to those people who are at home because they're not going to be commuting as much, so they'll save money on commuting, perhaps save money on childcare. So there's going to be a dynamic change in here on how the world's going to go forward. And so this is going to be a test case just to see how many people, how many businesses really can function with people working from home. And if it is, there may be some really improvements that are going to make things better. So that's just part of the adaptability in this environment, still assessing where we're at. No doubt. I mean, it's just speeding up some of the trends we've already seen, right? Like, for example, this shopping online and brick and mortar.
It's almost a forcing issue to say, where's this economy to get there?
So
good question.
Yeah,
thanks,
good question there. And it looks like we have another one with the hand up. I believe that's Glenn W. We'll go ahead and unmute Glenn and allow him to ask his question here.
Disregard. I was listening to the last question.
All right. Well, thank you for listening.
Well, now you've got to make up a question now.
What's for dinner?
No problem here. Just off the record there, that Chuck is real soft sounding and Josh is real loud and.
Be nice.
Well, nothing's changed, I guess, Glenn. Sorry about it.
So Marilyn's across the room listening. I've got my ear to the computer. And,
all right. And all right. Thank you, Glenn. So we got, one more question here. And this one came in, beforehand, and it's really about unemployment. We've seen huge, before the crisis, we were at almost full unemployment. And you're talking about how that's a big driver of when this economy can get. So, by the end of the year, do you see unemployment getting back up anywhere near it was, or?
Most of the projections.
Either of you, what do you?
Most of the projections, we're still looking at pretty high unemployment, and I think we can. It'll be years before we get back to full employment, which is what we had before, which basically anybody who wanted to work was working. It's going to take years before we get back to that, but we don't necessarily need to get back to that exact point. We just need it to improve and get better. No, I'm not overly optimistic. A lot of this depends, though, and this gets back to the swoosh or whatever you want to call it versus the U-shaped recovery, or however that. We've got to understand. This is why I started off the whole presentation here about we need to stay in the now. Right? Don't get stubborn. Don't think, here's what I thought 2 months ago, right? So right now we're looking at this, but a lot of this depends on the stimulus packages that the government comes out with, right? If they keep spending money, we call it don't fight the Fed. If the Fed is spending money, they are going to work sooner or later, right? They're going to spend enough to do it if they commit to that. And if they extend this bonus out for a lot longer, and now they're paying, proposals to pay people to go to work, and all these type of things could really change things. But based on what we see right now, no, if you look at the average time that it takes from unemployment to be at one level, hit a bottom, and then come back, you're talking about 27 to 31 months. and unless the just government spends so much money to get that back up.
Well, we're going to be in a transitional period too, I think, because back in the 80s, large corporations, when real estate values cut and we had high inflation, a lot of layoffs in the big industries. What happened is those people transitioned out and started small businesses, which brought us the 90s. So we're in a situation again, I think, where a lot of these people who have lost their jobs, those companies, many have gone bankrupt and aren't there anymore. They're not going to, it's not going to be instantly everybody goes back to work at the same place. They're not there.
Right.
So there's going to be a transition, which is kind of what Brian's alluding to. It's going to take a while. There's going to be other jobs because the world's going to change the way we do things. There will be other jobs, but it'll take a while for that to transition for these people to find work.
Yeah.
That's great.
I do want to thank everybody who did ask a question, because that really helps, because we want to hear your feedback. We want to make sure we're answering your questions out there, and hopefully we've added a little clarity to, again, the strategy of ours. But let's just stay a little bit off risk on the investment side, but don't overreact. Anything like that. Make sure we're active and we're picking the right industries, because people are very good about saying there's some industries that's going to be hurt more than others. It just is. And so, got to be, diligent about that.
People are just asking questions for their chance to win the $50 gift card.
Yeah, that's probably it. Yeah.
So we'll be getting to that in a second.
I submitted one of those questions too.
We'll be getting that to the second. We'll announce the winner from our last webinar here in a couple minutes. And thank you for everybody who submitted questions this week. If you still have any, go ahead and email those in. We'll answer them. You'll still be entered to win for this week's drawing that we'll announce in a couple days. We'll reach out by email. But if you enjoyed this content and want more from us here at Virtus, we encourage you to like us on social media. You can find the corporate Virtus Wealth Management page on Facebook, on YouTube, on LinkedIn. So we invite you to join us there. And if you go to our website, www.virtuswealth.com, you can sign up for our Virtus View email series. And so that will get all that information right to your inbox, so you can stay up to date on everything. And so
we're laughing here because Preston's given us the music. We're about to get the hook to get off
this
there.
This is a great time to give a special recognition to Preston Tillotson and Amy Tillotson for putting all this together the last several weeks. There's a lot of work behind the scenes. They've done a great job to help us provide this content. So quick thank you to them. And so without further ado, we will announce the winner of last week's gift card winner for asking a question. And this will be the restaurant of your choice. You'll hear from Amy. She'll reach out by email. And the winner on that was Dan C. So I won't give the full name, but Dan C., if that's you, keep an eye on your email for, to let us know which restaurant you want your gift card to.
Just do a couple of final comments.
Yeah, and so I did want to open it up before we go, just to see if there's any final comments you guys have, something that we didn't answer today that you really think everybody should know.
Well, I would just share that when one's an investor, you've got to realize there's going to be a percent down at various times. That's just normal part of investing. The other thing to remember is that bear markets are always temporary. And like I say, this is my 6th one. I thoroughly expect this one to be temporary. We don't know how temporary, but they're all temporary. And I always share with people, it's kind of like skiing. If you're a snow skier, you look at the tips of your skis when you're skiing. You got to be looking down the line a ways in order to properly get down the mountain. And then my last thought is, because we're talking about volatility in the markets, and today it's down significantly, and when we were talking Monday or Tuesday, everything was up. And so we use the analogy of an automobile, where the stock market's kind of like looking at your windshield wipers, and they're flipping back and forth. The dashboard's your economy, and things there don't move quite as fast. And as Brian's alluded to, there's certain things you want to pay attention to. But if you're looking at the windshield washer all the time going back and forth, it'll drive you nuts. So just keep that in mind, that that's what you're going to expect here, probably going forward for the next few weeks at least, I would expect. So that's what I would share.
Very good. Anything you need to close
I
with,
kind of
Brian?
jumped the gun earlier with my summary before I gave you a chance. Again, I would just add that be careful about chasing out there, but I think it's a mistake of thinking everything's horrible. We are seeing better news. I have adjusted my projections to see, like I said, more of a swoosh versus a a U shape. But that can change too. We can see things come. A second wave could be really bad, and we'll have to adjust. So don't get stubborn, hard-headed. Adjust with the news every day, and make sure you're basing it on the right news.
Great. Thank you again, guys, for joining us. That was great information.
Thank y'all for joining us.
Thank you everybody for joining us here.
Great turnout again. So
from myself, from Chuck, from Brian, thank you, and everybody else at the Vertus Wealth Management. Thanks for joining us, and we'll see you next time.
Bye, y'all.
Good job, Josh.
Yeah, great turnout.